Today, we will talk about ex-ante. The term ex-ante refers to future events based on forecasts or predictions rather than concrete results. Translated from Latin, it means before the event. Ex-ante can be used to describe the potential returns of a particular security or company. Much of the analysis conducted in the markets is ex-ante, focusing on the impacts of long-term cash flows, earnings, and revenue. While this type of ex-ante analysis focuses on company fundamentals, it often relates back to asset prices. Ex-ante is a Latin phrase that means before the event. It involves any prediction or forecast ahead of an event. In finance, this refers to anything that occurs before market participants become aware of the pertinent facts. Any research or analysis that financial professionals conduct is generally considered ex-ante. The information they provide in their reports isn't based on actual results because the event hasn't yet happened. Instead, it's based on their own predictions, often based on a company or security's historical performance. One type of ex-ante analysis that's particularly useful to investors is gauging ex-ante earnings per share analysis in the aggregate. Consensus estimates, in particular, help to set a baseline for corporate earnings. Analysts may also provide ex-ante predictions at times when a merger is widely expected, taking into account potential cost savings related to pairing redundant activities, as well as possible revenue synergies brought about by cross-selling. It's often impossible to account for all the variables for every form of ex-ante analysis. The market itself also sometimes behaves seemingly erratically. Ex post is the opposite of ex-ante. It's Latin for after the event. It's possible to compare expectations versus actuals once the ex-ante analysis's event passes. Sometimes, this provides additional insights. Analysts and investors can use any historic returns to make predictions about the future performance of investments and companies. Investors, advisors, and analysts can use ex-post analyses to calculate the largest scope of losses possible. There are obvious benefits and drawbacks of using an ex-ante approach when it comes to investing. The drawbacks must also be considered equally, including. Here are 5 key takeaways. 1. Ex-ante is a form of financial analysis that uses forecasting or predictions for future events. 2. This type of analysis is commonly used for events like earnings reports and mergers. 3. Ex-ante, which is Latin for before the event, takes historical performance into account. 4. An ex-ante analysis is not always correct because it is often impossible to account for variables and markets are also susceptible to shocks that affect all stocks. 5. Ex-ante is the opposite of ex-post, which is a form of analysis that takes place after the event and uses concrete results. Hope this would help. Thanks for watching.